Imagine waking up tomorrow and discovering that your salary has doubled. Not a promotion, not a bonus. Your paycheck is simply twice as large. Most people imagine that moment would change everything. The stress disappears, the bills stop feeling heavy, the future suddenly looks secure. For a few seconds, it sounds like the perfect solution. More income, more freedom, more happiness. But here's the strange part. Millions of people have already experienced some version of this. Over the last few decades, salaries have increased. Entire industries started paying more than previous generations could have imagined. Yet somehow, most people still don't feel rich. In many cases, they feel even further away from financial freedom. Which raises an uncomfortable question. If earning more money is supposed to make people wealthy, why does it rarely work? And why does the system seem designed to keep everyone running, but almost nobody escaping? Because the truth is not that salaries are useless. The truth is that salaries were never designed to create wealth. They were designed to create workers. And those are two very different things. To understand why, we need to go back. Not hundreds of years, just a few generations. For most of human history, wealth came from ownership. Land, businesses, resources, ships, factories, things that produced value while the owners slept. Then, industrialization changed everything. Factories needed workers. Companies needed employees. Governments needed stable economies. And gradually, society created a new promise. Get educated, get a job, work hard, on a salary, build a good life. For a while, that promise worked surprisingly well. One income could buy a house,
A family, pay for education, save for retirement. But then something changed, and most people never noticed. Their salary kept rising, but the things they needed rose faster. A person earning $20,000 a year became someone earning $40,000, then $60,000, then $80,000. The numbers looked bigger. Life didn't. Because wealth is not measured by how much money enters your bank account. It's measured by how much remains after everyone else takes their share. Taxes, rent, mortgage payments, insurance, transportation, utilities, debt, subscriptions nobody remembers signing up for. The paycheck arrives and immediately begins disappearing, like water poured into a bucket filled with holes. The system doesn't need you poor. It simply needs you dependent on the next paycheck. And that's a much more stable arrangement. Think about the average worker. They spend years increasing income. Yet each increase somehow creates new obligations. A bigger apartment, a newer car, higher expenses, a slightly better lifestyle. What economists call lifestyle inflation. What most people call normal life. The irony is almost funny. Someone gets a raise, celebrates, and 6 months later feels exactly as broke as before, just with more expensive problems. This is where the salary trap begins. Because salaries have a hidden ceiling. There are only so many hours in a day, and a salary is usually connected to those hours. Even highly paid professionals eventually hit limits. A surgeon, a lawyer, a consultant.
An executive. They can earn impressive incomes, but they still exchange time for money, and time is finite. Meanwhile, something very different happens on the ownership side of the economy.